Hello and good afternoon, everyone. Thank you all so much for taking the time to join us today. My name is Mark Bolger. I'm the Aging Care Specialist here at Pinnacle Financial, and today we're going to be joined by the Regional Vice President for Nationwide, Jessica DeLella, as part of our November Long-Term Care Awareness Month webinar series. Our first one here that we're doing for the first week of November, we're going to be doing it on Nationwide's CareMatters. It's a product training. Basically is a hybrid life slash LTC policy. It's very unique, and we'll be going over a lot of details regarding that here. So certainly appreciate you all taking the time. Let me just talk a little bit about Pinnacle for one sec here. Okay, so Pinnacle Financial, we're a national brokerage. We're located right outside of Philadelphia, up in Warminster, Pennsylvania, but we are licensed to sell in all 50 states. So regardless of where you are in the country, you can certainly, come on board and contract with us and sell any of the product lines that we offer. Some of those product lines include fixed indexed and immediate annuities. We do universal life, indexed universal life, single premium life, simplified issue term and universal life, traditional whole life, final expense, term life, long-term care, Medicare, hospital indemnity, and dental plans. And our website, for those of you who are not familiar with it, pfsinsurance.com. It's basically your central hub to, accessing all of the different products that we offer, the quoting software. It's available 24/7, so, you can use our website to submit e-apps to some of the various companies. We also offer discounted CEs, discounted E&O, so if you're looking to renew that, you can certainly take advantage of the discounts that we offer. We're always going to keep you up to date with all the current life, annuity, Medicare, and long-term care news. We have over 150 carriers that we work with, so there's tons of news, and updates coming up all the time. So we try and keep that all in one location right on our website, so that you'll be up to date with all of the carriers that we work with and any announcements that they have or new updates and things like that. We also do website creation. So we'll actually do a free one-page landing website. We just ask that the agents, they purchase the domain, whether it's, abcinsurance.com. Very inexpensive. It's anywhere from 10 to 15 bucks per year for those domains. So again, if you have a domain, or we can certainly make one up for you, certainly take advantage of, giving our design team a call to walk you through that. They'll work with you for, color schemes and, different logos and however you want your site to lay out. But it's a great way to, give yourself some web presence online. Nowadays, if you don't have some sort of website, when people are, talking to you, and if they don't know anything about you, the first thing they're going to do is look you up online. And if they just see a Facebook page or a LinkedIn page, sometimes that is okay, but you want to kind of have something that's dedicated to just what you sell. So we can certainly do that for you. Certainly give us a call. Certainly get you over to the right department. And like I mentioned, all the quoting software. So we have the annuities, the LTC quoting software, term, universal life, Medicare, and final expense quoting software. Okay, we also have a free mobile quoting app that you can download for free at the Google Play Store or at the Apple App Store. It's 100% free. All you got to do is type in Pinnacle Quoting, and you'll see our logo here, and you know that that's the correct one. And with this, it's a little bit limited with some of the products that you can quote, but you can do Medicare Advantage, Medicare Supplements, hospital indemnity, final expense life, and dental plans, all right from the mobile app instead of having to, log into our website if you're on the road and stuff. And then lastly, we have our online contracting link. So, most of you that are set up with us, this is pretty much how you came on board with us, is just by filling out this spot sign link. It's all 100% online and allows you to choose multiple carriers. It's, very time, saves you so much time. You can do it in about 5-10 minutes, super efficient. And also it's going to save all of your information in our system. So if, let's say you're set up with 5 of our carriers, but you want to add, maybe the Nationwide product that we're going to talk about today. All you have to do is contact us and say, hey, add the Nationwide, CareMatters plan. We'll go ahead, send out the contracting. We have all of your information, so all you need to do is just complete a contracting link, which will be emailed to you, and then within a few days after completing that, you will receive a welcome email from the specified carrier that you contracted with. So just a little bit about Pinnacle here. We're going to kind of keep it, under about 40 minutes or so here. So I'm going to go ahead and pass this over to Jessica DeLella, who's our rep over at Nationwide. She's going to talk about the CareMatters plan. And guys, feel free, if you have questions, certainly type them into the chat box, and we'll answer those accordingly as we move on. Okay. So Jessica, I'm going to pass it over to you.
Thank you so much. And thank you for having me today. I know with November being Long-Term Care Awareness Month, this is very timely that we get to have this conversation with you and your advisors on the line today. This is two products that I am very proud of with Nationwide, proud of all of our products, but long-term care is near and dear to my heart because of some family experiences that I've personally had. So I always enjoy when I get the opportunity to share about this, because I do think it's something so important to many of our clients, our family, our friends. So very valuable content that we have today. So again, feel free to ask questions, use the chat feature. Definitely, break in and ask them whenever we have them. Certainly want to keep it conversational and make sure that everybody gets the most out of this. So we'll go ahead and we'll get started. So as mentioned, we're going to talk about our CareMatters portfolio. So there's two products with this. There is an individual product, we call it CareMatters Together, and there's a joint product there's the individual product CareMatters II, and the joint product, which is CareMatters Together. And then there's a New York version of this as well called Your Life CareMatters. Slightly different. We're not going to spend too much time on the New York product today. We're really going to focus in on that individual product that's offered in most other states and that joint product. So today we're going to talk a little bit about how do we help prepare our clients for this conversation and for planning, right? Not every client has been through an experience, so they might have questions about this. And how do we help them with that planning roadmap? We're going to talk about the advantages of a linked benefit long-term care policy. What is it? What does it mean? What's guaranteed? What's not guaranteed? We'll go through that together. We're going to do a deeper dive into CareMatters Together and CareMatters II. We're going to give you some snapshots, some case studies. We're going to look at some of the policy features and actions so you can get a really good idea of how these policies work and why they're beneficial. And then we're going to go over a couple of key features and end with the resources we have for you and your clients, and then a little bit about Nationwide and who we are as a carrier. So with that, let's dive in. We're going to begin at the beginning with preparing our clients for long-term care planning. So a really big statistic, although I don't find this terribly surprising, 84% of people say that they would prefer to receive home-based care. I don't think that shocks anybody on the phone, that the majority of our clients want to stay in their home for as long as possible. Right? I think the majority of folks that I've personally spoken to, whether they be clients, our BGAs, our advisors, friends, they all feel the same way. You want to stay in what's comfortable to you as long as you can. Now, there are some folks that say, no, I've been through this and I don't want my kids having to take care of me. I'd like to move to assisted living and to a nursing home when needed. And that's okay too. We're going to talk about both of them, but I think this statistic is important to realize that most folks want to stay in their home as long as they can. And how do we help with that? So when you think about what long-term care costs are and what possible policies or resources we have to cover them, there's a big disconnect for the average client. The average client who is not in the industry like we are, inside and out every single day, does not realize that healthcare, insurance, Medicare, Medicaid, and long-term disability do not cover long-term care expenses. So there's a disconnect with the education that we have here. And I think that this is an opportunity for us to be able to have these conversations with our clients to educate them on the fact that some of these resources that they might already have that they think are going to cover long-term care expenses are in fact not going to cover those expenses. And so again, an educational moment for us to have with our clients to let them know what is covered and what is not covered by these resources they have access to. So let's pivot on and talk about the advantages of a linked benefit long-term care policy, such as CareMatters II or CareMatters Together. So these policies are primarily designed for long-term care coverage, but they are linked to a life insurance policy. We're going to talk about what that means and what are the benefits of that in a few slides here, but it's important to know that these essentially are life insurance chassis, but we design them to be long-term care benefit heavy. We'll go through all of that together today. The perk to this is that it pays the benefits whether the client ends up needing long-term care or not. So when you think about traditional LTC, kind of that use it or lose it mentality that, where we're paying in premium similar to that of an auto insurance premium, the carrier has the control to increase premiums anytime that they might see fit. Nothing's guaranteed in those policies for the most part. And if the client passes away peacefully in their sleep, we should all be so lucky, the beneficiaries get nothing out of that policy. There's no cash value associated with it. There's no death benefit associated with it. That is different from how these policies work, and we're going to dive into that. It provides immediate guaranteed leverage that is not tied to market performance. So there's no risk associated with this for your clients about if the market goes up or down. So it takes a lot of that fear and worry off of their shoulders because we're giving guaranteed leverage here. And with CareMatters II and CareMatters Together, we offer guaranteed premiums. So your client does not have to worry about getting that letter that premiums are going to increase, guaranteed long-term care benefits, guaranteed death benefit, and guaranteed return of premium options, all of which we're going to talk about today. So again, with CareMatters and CareMatters Together, they have options with this policy, which I think is why so many folks like it. There's long-term care benefits if they need it. If they pass away peacefully in their sleep, there's a death benefit for their loved ones. Or if they change their mind, they have liquidity and they can surrender this policy, or they can 1035 it into something else. So there's a lot of flexibility with this. It gives the control back to the client and their family. And I think that's why so many clients tend to look at this versus a traditional LTC solution. So we'll dive into CareMatters II and we'll get into some of the technical aspects of this product. So I've mentioned it in prior slides, but we're really going to hone in, and you're going to hear this pretty consistently throughout this presentation. The things that set CareMatters apart are going to be guarantees, choice, and flexibility. And we're going to kind of go over that theme again and again throughout today's content. So we have guaranteed long-term care benefits, guaranteed death benefits, guaranteed money back, and guaranteed paid up benefit options. So for instance, if a client changes their mind and they're 5 years in, we have something called reduced paid up. So they can stop paying premiums where they are. We essentially freeze the policy where it's at. The values stay in the policy, and that's guaranteed for the rest of the client's life. So a unique feature to Nationwide, but again, adding to those guarantees that are available to your client. Choice. We have 5 different payment options, 3 different inflation protection options, 3 different refund of premium options, and you can fund this with 1035s from cash value life insurance policies that might be out there, or lump sum payments, along with those 5 other payment options we mentioned there in column 1. So a lot of choice that we can design these policies to be exactly what a client needs, and no 2 clients have to be the same. So we could change all of these options client to client. It doesn't have to be cookie cutter, which I think a lot of clients like because everyone has different circumstances. And flexibility. So CareMatters and our rider on our life insurance policy, we are all cash indemnity benefits. And what that means is that the client and their family never need to submit monthly bills or receipts. We are not a reimbursement model carrier. We are cash indemnity. The policy owner can elect to receive all of their available monthly cash benefits or less if they want to. And the cash benefit can be used without restriction from Nationwide. So what does that mean for your client? Well, say for instance, your client has a daughter who works full time, but she's taken time off to help mom around the house because she's needing a little bit of extra help these days. Well, that time from the daughter's job could be a loss of income for her. With CareMatters II, even though the daughter isn't a certified caregiver, that mom can pay her daughter if she wants to. Say the son is coming to help cut the grass. Dad can't do that anymore. He's needing some extra help these days. That's not a qualified service, but because CareMatters is indemnity and not reimbursement, Dad can pay his son to come cut the grass if he's so inclined. Maybe your neighbor's taking you to some doctor's appointment. You can use that money to pay for gas. The cash indemnity gives the power and the flexibility and the control back to the client and their family to pay for care how they see fit. It does not just need to go to qualified providers or nursing homes or assisted living care facilities. That to me is a really wonderful thing to give back to the client and their loved ones when they're going through something, and can give them that flexibility to stay in their home longer, which we saw on slide 1 is something that most of our clients want. So let's talk a little bit about a case study here. This is a female client. She's 55. She happened to inherit $100,000 from her mom when she passed away. Lisa's already got a nest egg. She's feeling confident about her retirement income. So she decides that she's going to use that $100,000 to help purchase and fund a nationwide CareMatters policy. The immediate leverage that Lisa gets from this is $500,000. So we've just turned $100,000 into $500,000 for long-term care should Lisa need that immediately. It's pretty phenomenal leverage that we were able to create that. Lisa also liked the idea of receiving cash benefits. She did not want the reimbursement model. She did not want to have to be responsible for submitting monthly bills and receipts just to get her money back every single month. So she went with CareMatters II because that was able to provide her that cash indemnity benefit that was so important to her. So really great case study here, highlighting that leverage that we get from that $100,000 to $500,000 essentially overnight here with CareMatters II. So let's look at this in action. We'll get a little bit technical here. And again, feel free to use the chat to ask questions. We can certainly pause and answer those as we're going along. That's really important. So don't hesitate with that. So here's an example here. We're solving for $5,000 day one. We're increasing to $10,469,000 at age 80. We're putting on that inflation rider that we talked about. We have $120,000. That's the premium that's going in. That's going to be in your first bucket. We've added the 4-year benefit here. So we've got 6 total years of benefit. We call this the extension of benefits rider. This is technical. This is really, how the policy works. This isn't necessarily the level of depth you'd need to get into with your client with these different buckets. The really important thing is we've put in 120, and day one, we have $360,000 for a 6-year benefit should they go on claim tomorrow. Guaranteed minimum benefit is $24,000. So heaven forbid your client, use every single dollar of this for long-term care. Say they spend this full bucket of money here, day one, or this $812,000 at age 80. Their beneficiary is still getting $24,000. So that residual death benefit will always be there for them. So that gives a really nice benefit that if you do spend all of this money here in your bucket, your beneficiaries are still getting what I like to think of as like a final expense policy after that. And we'll talk about the death benefit should you not use this money. So if you die peacefully in your sleep, you never need long-term care. We'll talk about that in a minute. So cash indemnity, we talked about that. Again, the theme of today, guarantees, cash indemnity, flexibility and choice, 5 payment options, 1035 flexibility, our 3 inflation protection options, refund of premium, and retroactive payment on the elimination period. We haven't talked about that yet, but we will here in a minute. And separately identifiable premiums. So if you happen to have business owner clients, Because Nationwide has separately identifiable premiums, depending on how their business is structured, they might be eligible for tax deductions. If you have clients that use HSA accounts, they might be able to use their HSA funds to pay for some CareMatters policies up to the age-based limits. So there's some really neat things that we can do with this and help to find the funds for your clients. And Mark and Greg at Pinnacle can help with that. So definitely keep that in mind. So payment options, we talked about 5 different choices here. Now, CareMatters II, Your Life Care Matters in New York, and CareMatters Together vary a little bit by the premium payment options that are available. What we're talking about here is for the individual product outside of New York. You have the choice of a one-time single pay. You can pay over 5 years, monthly or annually. You can pay over 10 years. You can pay to age 65, or you can even pay to age 100. So for clients that are budget sensitive, you might have a little more design, parameters by looking out to age 100 and paying monthly. So what I love about this is we can meet clients wherever they are financially. If you've got, a 1035 or a lump sum you want to utilize, great. If you're a little more budget sensitive and maybe you're still in those cash flow years where we don't have a lump sum to put into this, but we do have some good cash flow, great. Let's look at some of these other options that are out there. So it gives a lot of flexibility to who you can help and how many clients you can reach with this particular product. And here's just a little visual of how that looks, right? So the single premium obviously is going to be larger. You could look at the 5 pay, smaller, but over 5 years, 10 pay, even smaller, but spread out over 10. Age 65, depending on your client's age, could be smaller, and then pay to age 100. Over time, this could be a more expensive option, but it gives flexibility to clients who don't have access to a lump sum to still be able to provide some protection for themselves. Any questions so far?
Hey, Jessica, thank you. Yeah, so one of the questions that came in just a minute ago was, I guess they were asking, what's the maximum age that they can do, in order to qualify for lifetime pay? And I think that's a good question too, because I know when I've been running some illustrations and stuff, like if I want to say it might be 70 is the max or 65, but I've run into that where I don't have I can't pay out to 100. It'll only go for the 10, 5, or single pay.
That's a great question, and that varies between CareMatters II and CareMatters Together. I do think I have a slide coming up on that. So if you don't mind, I will put that one off just a couple more slides so we can talk about the differences there between the two. But there are age limits on all of these. So that's something that's a good call out there.
Gotcha. And then just had just a comment saying, they love how the cash indemnity instead of the reimbursement model. They said that's huge, and they feel like they can, present this to some clients that have been looking for that flexibility. So I think that was very important what you mentioned about the cash indemnity. It's like, hey, yeah, if your son or daughter is going to help you or drive you somewhere or cut the lawn, you don't have to submit that, for the insurance company to be like, we're going to reject that. No, that money is completely flexible through that cash indemnity model. And I think that's very advantageous to a lot of people. And a lot of people don't even realize that about their whatever LTC plans that they have. So I think that's a huge thing to mention, during the sales process. So very cool.
Great. I'm glad that's resonating with folks, because I definitely see it as a valuable feature. So I'm glad that's striking the audience as the same.
Mm-hmm. Sure. And then we had one last one, and this was from Rob Reel. He's just asking about underwriting guidelines, and I'm sure that we'll be going over that with some of the resources that you have on some of the last tabs. And just to answer you, Rob, like everybody that's on the call, I will be sending out basically like sales kits on this product, which will have those underwriting guidelines, product info, client brochure, all that good stuff. So we'll get those to you.
Great question. We do have a good number of resources around underwriting and field underwriting. So I highly suggest pre-screening clients for these products. We've got 2 different guides that you can use. They're fillable. Essentially, if you've got a client that's pretty healthy, you can just look at the pre-screen, pre-qualification guidelines, kind of look at their medications, their conditions, and see if any of them fall into the knockout guidelines. If they do, you'll know that they're not a fit. If you find yourself in a gray space, we've got something called our pre-screen emails, where you can just submit an email to one of our underwriters and they'll take a look at the details. So you can either use one of our fillable questionnaires to fill that out and submit it to the underwriting email team, or you can just summarize it in an email. So if you ever find yourself in a gray space, you can always reach out to Mark and Greg and the team there at Pinnacle for some guidance, but then you and Mark and Greg have access to this email box where you can submit any of those cases where you might just be on the fence. Maybe you don't know if we'd be able to accept that risk or not. We can tell you ahead of time, and that's really going to help set the expectations for the process. And then once the case is submitted, I highly recommend submitting it electronically. It makes it so much easier. You submit it electronically. The client has the option to do a digital health screening essentially, or a phone, depending on their preference. You can decide. The digital takes a few minutes. They can complete it at their convenience from their computer. The phone takes about 20 to 30 minutes over the phone. It's just going to ask some health history questions. Once we have that, we essentially give all of that to the underwriter, and within a day or 2, they make a decision. Now, if your client's between 60 and 70 or 75, depending on the product, they will have to do a cognitive screening. If they're between 60 and 69, they can do this online. It's literally a 3-minute test. They pop in there, they answer as many questions as they can in 2 minutes, and we're able to score that and give them a cognitive score and tell them if they pass or fail. If they're between 70 to 75, they'll do it over the phone. It's about 20 to 30 minutes. So some clients, depending on their age, might have 2 phone conversations or 2 digital experiences, depending on their age. But once we have that, again, everything gets factored in, sent to the underwriter, and within a day or 2, they make a decision. Occasionally, we will order an APS. We usually do that when we're on the fence about something. So we're trying to make an approval, and we just need something in that file to give us the credits we need to get to the approval. So if it's a decline, it's just going to be a decline. But if it's on the fence, we're going to order that APS to try to push it over. For about 5% of the business, we order APSs. So very, very minimal. The whole experience is streamlined as far as underwriting goes. So we try to make it as easy as possible on the advisor and the client so that you guys have really good experiences with this, and streamlined underwriting, streamlined application, and with the help of Mark and Greg and the team there, just get these issued back out to you guys as quickly as possible. So hopefully that answers.
And that's I was going to say, absolutely. That's excellent. And you just made a great point there, is that a lot of people are under the impression that, a medical exam is involved. And Jessica just said that, what the streamlined underwriting process is. About 5% of the time they're going to order an APS, but a lot of times they can make that decision just based off of that phone interview, and, if that cognitive screening is necessary or not. So again, she said, within a few days, these can be issued. That is huge. I mean, anything that's fully underwritten, any traditional, just straight LTC plans that we have here at Pinnacle, they could take over a month sometimes. So that plus the email and the resources to do risk assessments with Nationwide prior to even presenting it to your client. We can check to see if this is a good if they'd be eligible for this or not. Again, that is huge. Nationwide have been excellent partners of ours here at Pinnacle. They're very, very professional, the most professional that you can get, and they're very timely to get back to us. And we'll always get that information back to you very, very quickly, as opposed to some of the other companies we work with where it's going to take a few days to get those answers back. So just wanted to just reiterate how important that is. So
I appreciate that. And we love working with you guys. So you guys make it really easy for us to get you back the answers that you need We appreciate that partnership. And just to reiterate, labs and parameds are never needed with this product. So there is no labs and parameds with this process at all. So we may order APSs, but never labs and parameds with this. So that hopefully will help as well. So with that, we'll talk a little bit more about the premium payment flexibility, because a lot of times clients say, well, I love this idea, this is great, but where do I find the money to help fund this? And something we really highly suggest is doing policy reviews. A lot of our advisors and agents uncover assets sitting on the sidelines, like old cash value life insurance policies that maybe were purchased when kids were young, mortgages were high, expenses were high, and they bought life insurance to cover those expenses in the event that maybe, one of them would pass away prematurely. Now we're finding clients that are coming upon retirement, kids are grown, mortgages are paid down or paid off, and they're starting to change their mindset about what's important. And they're looking towards funding retirement and possibly funding long-term care experiences should they come upon them. And we can repurpose those old life insurance policies via a 1035. So policy reviews are a great way to uncover potential assets to help fund long-term care policies such as CareMatters. And you can do any lump sum amount. So think back to that case study, Lisa, she came into an inheritance and she took some of that inheritance to fund CareMatters. A lot of our clients might be business owners. Maybe they're looking to sell their business as they gear up for retirement. They might be coming into some lump sums of money. We could reposition a portion of that to fund long-term care for them and possibly a spouse. Maybe they're downsizing a home. I see this regularly. I've seen it with some of my family members, in fact. They're downsizing a home that they've lived in for decades. They're coming into some cash value there from that downsize. So they might be putting some of that to buy a new, smaller home, maybe a rancher, or maybe they're looking to go into an assisted living facility. You can carve out a piece of that to fund CareMatters. So flexibility there, just a couple of ideas to think about where to find the funds, which I think is a valuable part of this conversation. And inflation protection. So we have clients that are looking towards this product younger and younger. We used to be looking in their 60s pretty consistently. We have clients that are in their 50s and occasionally even clients that are younger. Those clients statistically probably wouldn't need long-term care or have a long-term care event until their 80s, sometimes their mid-80s. So the money that you might be setting aside today at, say, 55 won't buy you the same amount of coverage that it would at 85. Things are going to be more expensive. We're seeing that trend now. So by putting on an inflation option, you're able to grow that money over time so that when the client's in their 80s, their mid-80s, maybe even a touch older, there's a larger sum of money in there for them to utilize for long-term care planning. So I think that's really important to be considering one of these inflation protection options for your client. And we give a crossover report in our illustration so that it'll tell you, at what point is it most valuable to add these on? And it'll give you a grid and it'll show you and say, hey, at 55, 3% compounding makes sense. But at 60, maybe it doesn't, or at 50, maybe 5% makes sense, but at 60, maybe it's too expensive. So that report is really great at giving you all of the options. And here's just a simple visual. I happen to be a visual learner, so I like to see these charts that explain to me and kind of show to me how these work. So you've got no inflation protection. So essentially, day one, you've got $5,999 a month. That's what you're going to have at age 80. That's what you're going to have at age 90, etc. That's not going to change. But here you go, 3% simple. You now have $8,804 at age 80. So same client, you can see that impact of inflation. At 3%, you have $10,000, and at 5% compound, you have over $11,000 a month. So that's the impact that inflation has on your client. So from almost $6,000 a month to $10,000 to over $11,000. Now keep in mind, that inflation protection, there's a cost for that. So we have to weigh that when we are illustrating. That's what that chart's going to help you with. Here's another case study for you, and this is just going to show you the inflation protection. 55-year-old male wants to begin planning for long-term care so that he can protect his family in the future. He went through a claim, or he went through an experience with his dad, and he had to, pivot and care for kids as well as caring for his dad and working. He does not want his kids to have to do that. So he's buying a policy now because he's worried about rising costs. So in his mind, he's looking for something with guarantees. So he's really focused in on that. So we're going to look at CareMatters. He likes that it's cash indemnity. He can base it on the schedule and whatever mode that Michael wants. We put on 3% compound for him. He starts out with $5,000 a month. So heaven forbid something happened tomorrow. Michael's got $5,000 a month to help him pay for long-term care. But if statistics prove true and he doesn't need this until he's 80, he's now got over $10,000 a month for long-term care. So some significant growth there because of the 3% compounding inflation rider. Now, if Michael passes away peacefully in his sleep, he never needs a day of long-term care. His loved ones will get $120,000 as a death benefit. Now, if Michael ends up needing every penny of his long-term care, he uses all of this money for LTC, his beneficiaries get $24,000. So always a death benefit. It just depends on where you are in the claim process to determine how much. And we illustrate all of that in the illustration for you. So we mentioned return of premium options. I think this is really another fantastic feature because people's lives change, right? Maybe things in 10 years will be different than they are now. Maybe the client will have a financial change of heart. They want to have options to pivot in and out of this product. So we've got 3 different choices. So when you're illustrating this and Mark and the team are helping you, you have a vested option, a one-time step-up option, and then most commonly we see the minimum refund of premium, but with the max LTC benefit. Statistically, less than 2% of these policies are ever surrendered industry-wide, not just with Nationwide, but industry-wide. So most folks are choosing this one because they want the most LTC benefit, and in exchange, they're willing to take less money on the refund of premium. Doesn't mean no money, it just means less money. And the illustration shows all of that for you. So here's how the vested option works. The refund of premium value is equivalent to all the premiums paid minus any withdrawals multiplied by the applicable percentage, of course. That percentage will grade from 85% to 100% over a time period. This is not available with the premium payments to age 100. So there's going to be some limitations based on what we're choosing because this product is so flexible. The one-time step-up option means that starting day 1 of the policy, 80% of the refund of premium is available. And then starting in year 11, 100% of the refund of premium value is available. So you're going to wait 10 years essentially until year 11 to get the 100% back. And again, not available with the pay to age 100. And then the minimum refund of premium maximum LTC benefit, this is going to be the lowest refund of premium value available, but it's going to maximize the long-term care pool for your client. And the elimination period. So this is something really unique to Nationwide and something I'm really proud of. We have a 90-day calendar day elimination period. It's important to note it's calendar day and not service day. Some carriers offer a service day elimination period. The key difference here is that if your client starts out needing only 2 or 3 days of service, that elimination period is going to feel like forever. We do 90 calendar days and we do a retroactive elimination period. Day 91, your client gets paid back to day 1. So for example, say they were getting $10,000 a month, that was their benefit. Day 91, they get a deposit in their account for $40,000 because we are retroactive. We're going to make them whole to day 1. We are, to my knowledge, the only carrier that does that. So think about that for a client who wants to stay home. They can use that money to put a ramp on the front of their house, lower countertops in the kitchen, maybe put a stair lift in the home. Maybe if they need an accessible vehicle, put some money towards that accessible vehicle. So this elimination period being paid retroactively like that is unique and very valuable. So definitely keep this in the forefront of your conversations as well. So with that, we're going to pivot to CareMatters Together. This is a joint life linked benefit LTC solution. It is the only cash indemnity based joint solution on the marketplace. So really excited to be able to say that we are the only cash indemnity joint LTC solution on the marketplace. So why is CareMatters so great? What does CareMatters offer? You're going to hear a lot of the same things I said with CareMatters II. It's simplicity for this one. It is a shared pool of funds. So it takes the guesswork out of who's more likely to need care, who's more likely to need care first, and when are they likely to need care. You have one big bucket of money that two insureds can use. So if you've got husband and wife, let's just get a CareMatters Together. We don't have to ask a lot of questions about, do we need 4 years for the wife? Do we want 4 years for the husband? We can just create this shared pool, and then I'll give you some visuals of how you can use it. More predictability. This is very similar to the CareMatters II story, right? Guaranteed premiums, guaranteed benefits, guaranteed death benefits. You don't need to worry about any of that when you use CareMatters. And more control. The benefits are sent directly to the policy owner, and there's no restrictions from Nationwide on how it's used. Again, that indemnity-based model gives that control back to the client. So how it works, the clients select a total number of full monthly LTC benefit payments they want to have available to them. So instead of doing like a 4-year, 5-year, 6-year, 7-year benefit, you can pick 48 payments, 72 or 96. The shared pool eliminates the need to decide how much to purchase separately on each individual. Now, where I see this coming into play is occasionally we will have the husbands tell me, I don't need this. I'm going to die in my sleep. I'm going to die at my desk. I'm not going to need long-term care. Let's just get something for the wife. I can almost guarantee you that wife then counters and says, no, you need to get something because I can't physically take care of you. I may want to emotionally and mentally, but physically, I am not capable of helping you get up off the ground if you fall, getting you in and out of bed if you should need help with that. Physically, she can't do it. So a lot of times we see those husbands who, have always been the provider of their family, and now they're in this position where they might be vulnerable. Psychologically, it's a lot to take in. So this eliminates that. We can get this, and if she needs all of it, great. And if it turns out that he might need a little bit of care, we have this in the background for him. So it really helps framing that conversation with spouses in some situations. And the LTC benefits can be split however the couple decides. Nationwide doesn't determine that, and I'll show you some charts here in a second. So let's say we have this couple here. They get the 72 payment period that we talked about. Monroe ends up needing a little bit of care for 24 months, and then unfortunately he passes away. So he uses 24 payments. Then there's 2 years where nobody needs care. Dolores is great, she's in great shape, but then in year 4, if we started from this, start period here when Monroe needed care, Dolores ends up needing some care. So we turn the benefits back on for Dolores, and she finishes out the rest of the policy for a total of 72 payments. So this is an example of how you can split this policy, even with some downtime in the middle, which does not count towards your payments, but it gives you the flexibility for the client to use this however they see fit. Now, here's an example of overlapping coverage. So Stephen ends up going on claim. He needs care here, for 2 years, and then Michael ends up needing care consecutively with him or concurrently with him. So now we're getting double the payments during this period of time. So Stephen ends up with 42 payments, Michael ends up with 54, but there's a period of time here, about a year and a half, where Michael and Stephen are each receiving benefit payments. So we're doubling up in those months. And then here's an example where John goes on claim. He has 96 payments. That was what they chose when they purchased it. And he ends up using all of the benefit because he needed it. And Lori ended up not having any benefits left. This is just to illustrate the flexibility of this policy, that the clients can choose how they want the benefits paid and when they want the benefits paid. I feel like we've chatted about this a good bit, but cash indemnity versus reimbursement, no need for bills and receipts to be sent to Nationwide. 100% of the money is available. I like to look at this like a long-term care paycheck, right? The first of every month, you're getting a deposit from Nationwide for your LTC benefits, no questions asked. Reimbursement model is actually the opposite. Every month, the client and their family need to fund their long-term care expenses and then submit those receipts and bills in the hopes that everything gets approved and they eventually get that money back. So they have to have money to pay for this care, only to get reimbursed for it if it's approved. Cash indemnity is the opposite. The first of the month, you're getting your paycheck deposited right into your checking account, no questions asked. Any questions on that so far?
Yeah, no, that was excellent, Jessica. I think it's very easy to understand. It just totally makes sense for for people to pick this up and offer it to their clients. One of the questions we did get, and this is a very, I'm glad he asked this question, but I'm asking, is the policy at risk of required spend down if a client is attempting to qualify for Medicaid?
Oh, that's a great question. And I think I have a white paper on that. So
I was going to say, I think I have one too. I remember seeing one. Sorry.
No, that's okay. I think there's two different situations that Sean Britt, who's kind of our LTC guru, brought up. And she said, I think there is one situation where it might be, but I kind of defer to her for more of those legal, financial conversations because they're frankly a little bit more above my head than what I deal with every day. So if you don't mind, I will look for that white paper and I'll email it to you so that you can share it with that individual who asked the question.
Oh, yeah, that would be great. And Jim, who asked the question, we'll follow up with you and get you an answer on that, after the call and everything. Thank you so much.
Yeah,
it looks like, let me just see if there's any other questions. I think that was it. Oh, here we go. Since this is on a UL chassis, if the client wants to turn an income stream on later in life, can they do that tax-free? I don't think this is really
so this
goes with this policy. Yeah, more of that. That would be more of IUL, like distributions and stuff. Yeah. So that's a little bit would be like a different type of product there, David. And I can certainly give you a call after the after this here and kind of run through the differences and show you some options in that respect. So,
and we do have that. So we've got our IUL accumulator, which does a fantastic job building cash value for clients to take out, potentially for retirement or whatever they might like.
Sure.
And you can put our LTC rider on that. So it's going to be cash indemnity too. It's going to work a little differently than this, but it'll give you some options for cash accumulation and distributions as well as LTC. So definitely something we could talk about there, but CareMatters isn't the policy for that.
Gotcha. Excellent. And then one more question too. Robert's asking, does the wife need to be eligible for long-term care to split the payments? I'm assuming that they're both going to have to be, right? So
they both have to be underwritten. And we'll talk about that in a second here for CareMatters. How does that underwriting differ a little bit from the individual process? But they both have to be eligible to be underwritten and to get approved for it. But at claim time, only one has to be eligible for claim. So you could have one client on claim, you could have both clients on claim. One could be passed away, one could be living. There's no gray space there, I suppose, with claim time, how to get the benefits, and if one has to be alive or deceased, or both on claim or one on claim.
Perfect. Absolutely. Yes. And just to quote, or not to quote, just to get back to David here, yes, we will definitely get that white paper to you guys, within the hour after the call here, as far as the Medicaid spend down.
Perfect. I'll get
perfect.
A couple more slides here. Issue ages here. I know we had talked about this earlier. This is for CareMatters Together. Using those different pay options, you'll see there are some limitations here for that 20 pay to age 65, or excuse me, pay to age 100 is age 65. So limitations there. The individual product, you can go up to age 75. On the joint product, the max age is 70. And on the joint product, we can only have an age difference of 25 years max. So just keep that in mind. I have not run into this personally yet on a case that I've worked on, but I'm sure there's some situations out there where the spouses might have a large age gap. We have to have an age gap within 25 years.
So basically, the 70-year-old can't get him and his 30-year-old girlfriend on this, right?
Yeah. Or vice versa, whatever. Yeah, you wouldn't be able to work with that one there. Underwriting classes on the joint product, you can actually have one standard risk class. So on CareMatters II, the individual product, the only risk class we offer is preferred. Everybody's either preferred tobacco or non-tobacco. Qualify for it. It is a range of risk classes. So when you think of traditional underwriting, think like preferred to table B. That's what preferred is. Standard is going to be table C and lower. So again, a lot of risks can fall into that, but only one can be standard on CareMatters Together. The other has to be preferred. And we can always help with that with the pre-qualification guidelines as well. Some product limits here. You'll see minimum monthly LTC benefits at issue is $1,500 here in most states. There are a couple of state caveats that we have going on. The software will tell you all of this. So you never need to worry about any of these. You go into the software, you check your state. It's going to make sure you're following the guidelines for you. The maximum is a little over $20,000, almost $21,000. Premium payment options, very similar to the CareMatters individual chassis. Single, 5-year, 10-year, 20-year. You'll notice we don't have a pay to age 65 because we have 2 lives on here and we wouldn't be able to do the math for that. So we just did a 20 pay instead, and then a pay to age 100. And the one unique thing about CareMatters Together is it has true waiver of LTC premiums while benefits are being paid. So if you're doing a 20 pay and year 10, your spouse goes on claim, we waive the premiums. You don't have to pay them back. They're truly waived. So say you're doing a 10 pay and year 8, your spouse goes on claim for 2 years and then comes off claim or passes away. Those last 2 years of the payments are waived completely. They're not owed back to Nationwide. So very unique, it's different than how the CareMatters II policy works. Again, inflation options are available with this. Now, the guaranteed minimum death benefit on CareMatters Together is 10%. It is 20% on the individual product. So there's a larger residual death benefit on the individual product versus the joint product, but still a nice, what I like to think of again as a final expense amount for your client's loved ones. A little bit on claims. How does a client qualify to be on claim? They have a severe cognitive impairment, think Alzheimer's, dementia, things along that line, or they can't perform 2 of the 6 activities of daily living, which are listed here for you. So once that's met, the client completes that 90-day retroactive elimination period that we spoke about. Day 91, they start getting their benefits. They get day 91, they get the 4 months paid, and then they pick up every other month from there for their monthly benefit.
And I think, sorry, real quick, Jessica. So Robert had asked a question, and I think that helped solve it right there. But he was asking, does the client have to essentially recertify each year to continue getting the payouts? It's almost like if they need it for more than a year, then they can just simply get those benefits, right? I mean, they don't have to prove that they're, that they need to go on claim each year.
Correct. Now,
assuming, right?
So they would not have to go through that 90-day elimination period again. That's once. Mm-hmm. Now, we reserve the right to ask some questions every 12 months, essentially. So if, say, your client went on a temporary claim, they went skiing, they had a really bad leg break, and they're going to be laid up for, several months, 6, 9 months, 12 months in recovery. they're on temporary claim. You can do temporary or permanent claims with us. So
Okay.
in 12 months, we might ask to recertify to say, hey, we thought he was going to get better. Did he get better? Great, he did. Awesome. We're going to turn off claim now. If your
Gotcha.
client's diagnosed
Gotcha.
with Alzheimer's or dementia, we look at those as lifetime claims. Those are permanent claims. We're less
Sure.
likely to be asking so many questions in 12 months because we're expecting that that's going to be a permanent claim for them. So we reserve the
Gotcha.
right to ask the questions, but it might vary based on if it's a temporary claim or what we consider a permanent claim.
Gotcha. Excellent. Thank you for your question, Robert. That was a good question there.
Yeah, absolutely. And so just in summary here, we've got a lot of resources to help you through this process. Come claim time, we're very unique in how we process claims. We assign a claim coordinator to your client. So they have one person they're working with, and that person is going to help them through any paperwork, help them get their plan of care, help them get through that to start turning on their benefits. It's not an 800 number. It's not a random customer service, portal where clients are just calling in, getting a different person every time. They actually get assigned a care coordinator to help them. We've seen this process. I've actually been able to see it personally now. It is phenomenal at how helpful that person is. So love that. The way we process our claims, it's different than most other carriers. We've got a whole plethora of marketing materials for you. I'm going to get these to the Pinnacle team and they can share a lot of these with you. That pre-qualification, pre-screening guide I mentioned, you'll have access to, as well as just marketing pieces that we have. So guides for your clients.
Absolutely. I'll send this out to everybody after the call. Yeah, I have all this stuff downloaded and everything. So perfect.
Awesome. Great. And that, we have access to everybody. I mentioned Sean Britt. You guys have access to her, our retirement institute, our underwriters. You have access to all of that. And then nationwide, a little bit about us, just quickly, mutual company. We've been around for almost 100 years, 1926. So in 2026, that'll be our 100th birthday. We're a Fortune 100 company. We've been offering LTC solutions since 1999. So not new to this space at all, and incredibly rated, very strong financial. So when you're looking for these long-term solutions, look towards carriers that are strongly rated, that are going to be there when claim time comes around. Diverse portfolio, financial services, P&C, commercial and casualty, property and casualty for you as well. So well diversified and ready to help. So with that, I'm going to turn it back over to you. Let me just see if I can do this.
Sure. Well, thank you so much, Jessica. We certainly appreciate it. And I'm just going to end real quick here with, mine and Greg Otis's contact information. If you guys, have any cases you're working on, if you want to do some risk assessments, maybe you have a client that you have in mind after going through this presentation today, please certainly reach out to us. And then I'm going to get everybody those materials that Jessica had mentioned, including the white paper on the Medicaid spend down. I'll get that to everybody that's been registered for the call today. And again, thank you so much, Jessica. This was very informative, and I think a lot of agents are taking a lot of good stuff away from this. So we certainly appreciate it, and I know you have to run. And everybody will have a copy of the webinar that you can view at a later time, share to any of your other agents. We'll get all that stuff over to you very shortly. So thank you all. Hope you have a great rest of your day, and good luck with AEP for those of you that are selling Medicare. And we look forward to hearing from you and answering any questions you may have. Thanks again, everybody.